it was very difficult to go to your customers when they come to the branch and say, well, I want the same thing that my friend has from Saudi Hollandi Bank. And they come to Saudi British Bank, which is a part of HSBC, and we say, sorry, our Sharia standards don't allow it. It's hard to retain a customer in that environment. And then a big point, which I won't talk about in detail, is regulatory constraints. So banking law is designed for money lending, which means that banks are not supposed to be investors. And if you look at Islamic finance, the most important verse in the Quran about Islamic transactions, it's a very powerful verse actually, because it addresses this question about interest and finance, because it quotes people who question the prohibition on interest, and it says, and that is because they say that indeed interest is just like trade. And then the verse continues, وَأَحَلَّ اللَّهُ الْبَيْعَ وَحَرَّمَ الرِّبَا, whereas God has made trade permissible, and He has made interest or usury impermissible. So there's a big difference between trade and sort of money lending, usury, and the Islamic vision is for the financial intermediary to take some sort of commercial risk, ownership risk, some trading risk, etc. And that's the ideal. But banks are not allowed to do that by law, neither here nor in the GCC nor in most of the Islamic world. So it becomes a very complex problem. So this is a question then that one needs to ask oneself: is this a necessary trade-off? Because what we've seen is that as the market share for Islamic finance has grown, the authenticity has been compromised, at least in my view. And then the question is, will this last forever, or will you see a change whereby customers will start to insist on more differentiation? That's something will be sort of unanswered question. But certainly today, the industry has seen it necessary in order to gain market share to be less strict on the Sharia standards. Okay, now on the trends part, which I'll do very quickly, and then I'll open it up for the questions. So the first trend is about more alternative investments and more sophisticated investments. And I won't talk about this slide in detail, but the idea is that the Gulf has been a very conservative investor historically for a lot of good reasons. And therefore they've been very conservative, and that's what's driven them. So some of the reasons are, for example, that they have a lot of uncertainty about oil income. So they needed a high degree of liquidity, especially Saudi Arabia, because in the 90s, for example, when oil was in the teens and even in the sort of single digits for a while, there were big time deficits. So they needed to draw on their reserves. And there's also a very important concern about not overheating local markets. So if you look at as you know, I mentioned some very large figures for Abu Dhabi, Kuwait, Qatar, very large sovereign wealth funds. Now, if they were to invest in their local markets, they would completely distort the markets because they could throw the market up, significantly. And then when they tried to exit, the market would crash. And that's why they like investing in deep markets like the U.S., because you can come in and out and you're not affecting the price with your behavior. Why are investors becoming more Sharia inclined? There are three reasons basically. One is that Islamic liquidity, meaning deposits and other assets that are kept explicitly in Sharia compliant banks or Sharia compliant entities, is growing. So therefore, if you're an Islamic bank and you have a treasury operations, you need to invest your money in a Sharia compliant way. Hence, there's more demand for Sharia compliant investment. Also, the industry has been evolving and introducing new products that can give customers what they need, what they're familiar with, without sort of compromising on performance. And that's been a big enabler, especially in the Saudi market, for the retail customers to switch over to Islamic. And then, of course, a very interesting last element is a preference for internal and external stakeholders. I have a good friend who's a CEO, or used to be the CEO of one of the big investment vehicles in the GCC. And it was one of the vehicles that provided benefits to the people of the country. And so when I was talking to him once about Islamic finance, he said, Aamir, that's very interesting to me because, people come to us now, increasingly, and they say, well, we are Sharia compliant people, in the sense that we use Sharia compliant banking, we invest our own personal money in a Sharia compliant way. So we want to know if what you're doing with our collective wealth or the benefits that you give me, or is that coming from a pool that's invested according to Sharia or not? And of course the answer is no. But there's increasing sort of pressure from the populations which say, well, Islamic finance is seeming more and more viable, therefore why aren't our institutions more open to it? In terms of disclosure, you've seen a lot more visible Gulf investments, and the reasons for that are threefold. One is because they're simply investing in assets that require more disclosure. So when you buy big stakes in companies, that's a public event, whereas buying lots of small stakes in companies is not reported. But there's also a shift towards a broader base of institutional stakeholders. And by that, what I mean is that, as families grow, for example, you get more siblings, more children, etc., and they want to operate more like the companies that they're used to seeing in the outside world, so issuing annual reports and issuing dividends and being much more structured. So when you have only one or two people, even in our case, right, all of us have our own savings and investments, no matter how modest they are, but we don't go around publishing that because it doesn't matter to anybody. Nobody can decide, nobody gives us that money in the first place explicitly to invest, nor are there any beneficiaries of that wealth besides our immediate family. As that has changed in the Gulf, so have the disclosure practices, and of course the regulations are pushing towards much more disclosure. If you read the Financial Times, there's a piece today about this Al-Ghusaybi and Saad Group dispute that's going on in Saudi Arabia between two private investors, and it's getting ugly. But one of the outcomes may be more stringent disclosure requirements, which would probably be good for the market. Just to very briefly show you the geographic allocation, one of the trends I talked about is a shift towards more emerging market investments as well as regional investments. So in 1974, the U.S. was getting almost half of Gulf surpluses, and the UK was getting a pretty impressive 31% of the investment. And you see the developing markets only had about 8% of allocation for Gulf investors. If you look at 2008, interestingly, the U.S. is getting a bigger share of this investment than it had before. But all of Europe, so the UK, remember, was about 30. Now all of Europe is about a fifth of the allocation, and then the remainder, Arab investment, Arab and Asian countries together about 22%, and then other kind of emerging markets. So this is a pretty significant shift towards emerging market investments. And if you look at the private equity investments that are done by institutions that are based in the region, Egypt, interestingly, gets the biggest allocation or the biggest investment. And again, there are pretty good reasons for that. Egypt is the biggest market by population terms. So Egypt has about twice as many people as the whole Gulf combined. So it's a big market. And also it's an open market where you can buy and transact more easily. For a Saudi company, it's very interesting. The leading Islamic bank in Saudi Arabia is Al-Rajihi, which is a very strong bank. And the second country that they opened in was Malaysia, which is an important market because it's important for Islamic finance. But of course, you would expect that a Saudi bank, as it expands, should first go to Kuwait and then go to Qatar, maybe then go to the UAE. But the regulations don't allow for that, even though they're changing. But still, it's pretty difficult to expand within the Gulf. So Gulf companies look outside to make investments, and Egypt is a good place for them. And this is really the last one that I want to close on. Because it's important, when you think about the Gulf from an investment perspective, a lot of people, when I was talking about the first book and the GCC region and the growth over there, there's a lot of people say, well, we want to invest in the Gulf, and can you tell us some investment strategies for putting our money to work in that region? And I'm always very wary of investing in the equity markets of the GCC, and I think if you look at the history of these markets, you'll see why. They've been very volatile, and there's some structural reasons for that. The first of which